Peter Rose, Longwood Currency Trading. It's early October of 2021. We're starting to get some fall foliage going here, and it's a great time to talk about good volatility in the Forex market versus bad volatility. The changes of the seasons aren't volatile, but price action can be. And it's interesting because there is bad volatility. You know, we always say that if you don't have any volatility, then I mean you can't trade. So let's look at the negative of that aspect, which would be the low volatility. You know, if you're a short-term trader and you're in a low volatility situation, then that limits the number of trade entry opportunities that you're going to have because price is not moving enough in order to create those structures or whatever it is that you're using in your analysis that would give you an entry opportunity. And look, even if you're a long-term trader, low volatility, you'd say, well, that's great because once the trend is established, then I'm just going to jump on there and I'll just ride that trend up. And that's very true. That becomes a very safe thing. But if you look at it from the standpoint of the holding period that you're going to have in order to achieve the level that you're trying to get to, I mean, you've got two issues. One, how long is that low volatility situation going to continue? And when it breaks, is it going to break against you or is it going to break in your favor? I mean, that causes some concern as to how you're going to trail your stop, right? The second thing for a long-term trader is the length of time that you actually have to hold the trade in order for it to come to fruition. And you have to balance the amount of money that you've made divided by that time period as a function of the overall risk that you've had to take in order to get the trade. And you could say, well, once the trade's in profit, geez, I just trail the stop. Well, yeah, that's true, but you're not going to jump on that trend all the time. A certain percentage of the time, you're going to lose. And where are you going to? You're a long-term trader, so what are you trading for? 50 pips? Well, I don't think so. You're trading for 200, 300, 400 pips, and so your stop is 100 pips out on the entry side. You give that price room to breathe. So you're taking a 100 pip risk, and yeah, let's say you get the 300. So you're 3-to-1 on your reward to what you initially had to risk. And I'm not a big favor of calculating stuff like that, but let's just, for those of you that are, you've made 3 times your risk, 3R, which is it's not a good ratio. Anyway, you've made 3 times your risk. But if it took you 2 months or 3 months to do that, you have to divide that $300 by 90 days to get a daily return. And does that justify the 100 pip or 100 pip risk? I mean, I don't know. I don't think it does. It's hard to say. If you're a long-term trader, you're gonna argue with me about that, right? And that's fine. I think that's a consideration that you do have to take if you're evaluating trading in low volatility situations. Now, what about high volatility? I think that becomes a real problem because it tends to lead to very choppy price, regardless of the time frame you're on. You're constantly running opposite pin bars. You're running what they call railroad ties. You're running pseudo dojis, big bodies but long wicks and big tails. It's uncertainty at the max. And so whether you're trading up on a 4-hour chart or whether you're trading on a 5-minute chart, if you've got high volatility, that price is just up and down all over the place, and you can't trade that. It becomes too dangerous. Well, so what's the simple solution as far as volatility goes? Well, it's not to trade, but those are instances of low and high volatility taken individually, and that's bad volatility, and you can't trade that. Well, what's the good volatility? Well, good volatility is volatility that moves in one direction, okay? And the direction is a function of what we call momentum. In physics, momentum is some mass multiplied by its velocity, right? Momentum is mass times velocity. But the velocity itself not only has a magnitude, in other words, how big is the velocity, but it's a vector, and it gives you a direction. So velocity has a magnitude and a direction. So the momentum has a magnitude and a direction. And so therefore, when you have high volatility, the velocity is really what you're talking about, combined with the direction, so you have a magnitude component with the velocity, with the direction component to make up that velocity, the momentum, that makes up the momentum, which is a different expression than just volatility itself, which is the speed that the price is moving around at. If price is just moving around randomly and has, in other words, the magnitude changes and flips between positive and negative with that velocity factor, then you have a bad situation. However, if you have high volatility with a single direction, then you've got a really good thing, because that velocity will help that price maintain that direction over a protracted period of time. And you've seen those actions take place. In fact, that's one of the ways that we can double team on the thing. You catch that movement early in the price movement. You've got this velocity, maybe you got some chop, and then all of a sudden you get the directional component to it, and the thing starts to break out. You see this when it breaks out of a support or resistance zone, or maybe on some kind of a flag pattern, or a wedge or something like that, if you believe in those kinds of patterns or indicators or whatever. But once that velocity establishes, once that volatility establishes a direction, boom, you jump on that. If you catch it right, you go way up. If the velocity has gone in that direction just a little bit and it's wrong, well, it'll go up a little bit and then it'll start to chatter and come back against you, and you can get out. So there's safety there, and that's particularly true up in the higher time frames. It's a little more difficult to manage when you're down on the lower time frames. I need a cup of coffee here. It's a little more difficult to manage on the lower time frames, because your profit targets and your risk points, your entry risk, your stop, they don't have a whole lot of real estate to it, so they don't have a whole lot of room to run, right? So you have to consider all that stuff. But if you can catch that early on, and that thing starts to take off on you, well, man, you just ride that all the way through. Normally it will take you through whatever projected profit target that you can have. You start to trail your stop behind that mentally, because you don't want the thing to just pop down and continue back up. You have to judge the candle size for that in relationship to whatever the ATR was 4 or 5 candles before that, so that, because the ATR is an average, so if you take the last 3 candles, which are blow-off candles, and you add that to the ATR, it changes the ATR, and it shades the magnitude of what you're trying to look at for your analysis. It kind of skews things. So you have to kind of throw the ATR concept out for recent activity, and what was it? So how far is this price going to go? So regardless of that, when you have a blow-off situation, let's say you have 3 15-minute upward candles, and the normal ATR for a 15-minute candle is, let's say, 8 pips, and these guys are running 15 pips. So you have 3 times 15. I mean, you're 3/4 of an hour of data. This thing is just going to go up. Well, at some point, all the order fulfillment has to get, or the orders have to get fulfilled and wrapped up, and you're going to run into some resistance. Whether you're short or whether you're long, it doesn't really make any difference. But you'll run into that order resistance, so you close your trade. Well, when you have this big run up like that, it could be the activity of a major institutional player. In which case, once they're done, let's talk about the upside. Once they're done with their buying campaign, where do you think price is going to go next? It's going to come down. And it could very well come down with the same volatility that went up with, because you get all this panic buying on the way up, and then everybody's heading for the exits at the same time. How far down will it come? Well, it usually comes down about half of the distance of the main run. Well, but people just state that, the 50% retracement rule out of the stupid fucking Fibonacci pattern of death or whatever. It has nothing to do with Fibonacci. It has to do with order fulfillment. And if you understand the psychology and the economics behind the traders and the countries that they're trading their currencies for, then you'd understand why that price might collapse of 50% and then start to stagger. And then it could continue on up if it's a real deal, or maybe that's the end of it, and now you'll start low volatility decrease in price. So those are the kind of the things that you look for when you have the volatility or the velocity of price combined with a direction, right? Because if you get that, then that's good volatility. So low volatility and high volatility by itself is just random. It's just shotgunning all over the place. Although low volatility isn't shotgunning all over the place, it still has their problems for whether you're short-term or whether you're a long-term trader. It's the volatility combined with the direction and the magnitude of that velocity at that point, the magnitude and the direction of where that price is going, that really, as a trader, that you can take advantage of. How often does that happen? Not very often. But when it does, and you get 3 or 4, 5 times whatever your normal risk is. I mean, because I'm a short-term trader on a 5-period ATR time frame, my 8 pip stop, I mean, when I run the thing out and I grab 20 or 30 or 40 pips, and maybe I'll do that in 2 hops or 3 hops by jumping in and out of it a couple of 3 times. But it makes that small stop, it absorbs so many of those losers that when I then go back in and I'm only grabbing 6 to 13 or 18 pips of the available real estate, the 20 pip distance that I have between my entry point and the profit target, which mandates whether I'm going to even look at a trade entry or not. The times when I don't make it quite to the profit target, which is most of the time, I've got to settle somewhere in between that, at 10, 14 pips, somewhere in there, about half of that. Statistically, I can get about half of that from a probabilistic standpoint with a good win-to-loss ratio, right? So then that short stop that gets hit many times, because it is a short stop, I have to perfect my entry, which is really what I should be doing instead of just playing probabilities. I have to have good entry analysis in order then to way over compensate on the wins for the number of times that I would get stopped out on that. So the volatility plays a huge role in making up the really good trades that run past, for example, where I would normally have a profit target at, and they would go 6, 8, 10 pips beyond that 20 pip. I mean, you're saying, well, it's only 6 or 10 pips. Well, yeah, but it's 50%, 40, 35 to 50% more than what I wanted on the profit target. That's 30 to 40% more on my profit. These little movements on pips, and I've done videos on the importance of just a pip that affects things. that you have to really take care of. You have to be aware of this stuff as you trade through. And so I hope that video was helpful for you and shines a different light on how you take a look at the volatility aspects of price action. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.